Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss interest rate policy, diversifying in digital assets, as well as IRS Direct Deposit, and we'll venture on over to the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we, good sir?
Doing well. Yeah, spring is here, so it's nice and sunny and green. It's been good.
Yes, sir. Absolutely. Time to get outside and start enjoying. All right. Well, let's dive right in. Interest rate policy. 2026 has been quite a roller coaster ride for the financial markets for sure. And the same is true around the interest rate expectations. We've discussed this quite a bit. It's definitely a hot button topic, making some of the headlines. Where do we want to dive in on this?
Yeah, so obviously there's been a lot of change this year. We've seen a fair amount of change in inflation and other factors. We've seen kind of that roller coaster ride you referenced in the financial markets as it's digested these different changes. And I think interest rate policy is a big one because beginning of the year. The expectation was that the Fed would, hold interest rates tight probably for the first half of the year, and then resume lowering interest rates, right? So basically that they would have paused for about a year. We had the high inflation, higher interest rates. As inflation came down, the Fed lowered rates. Then, they paused for a while. Market was pricing in that would last about a year, and then they would be in a position to start lowering rates once again. To get to a kind of a more normal, lower interest rate level. I think largely on the expectation that inflation would continue to decline. But with recent developments, we've really seen those expectations shift, and people are really rethinking, what that future path for interest rates may be.
Yeah, well, let's dive into some of the different factors. I mean, the global economy has definitely played a role in it. Things are going on, as we know, around the world. But you highlight cost push inflation. What exactly is cost push inflation, and how is that playing a role in where interest rates are at right now?
Yeah, there's two forms of inflation. There's cost push and demand pull, and the difference does matter, especially as it relates to policy. Cost push is typically when commodity prices are rising, right? And it's either due to just the market being undersupplied, some type of supply chain disruption, like we're seeing now in the oil markets and as well as some other key commodity markets. Whereas cost push is when consumer incomes are going up faster, maybe the wealth effect because, the stock market or the real estate market are doing well. People are feeling wealthier. They're spending more or willing to spend more, but there's not necessarily more goods and services, right? So they're bidding up those prices. Demand pull inflation is typically easier to deal with because it basically just relates to trying to raise interest rates to reduce the level of demand to be in line with, what the economy can support. Cost push is a much more difficult one because, as we're seeing right now, raising interest rates to try and slow the economy isn't going to help, right? The real underlying issue. It's just a pure supply disruption. So, the Fed's kind of in a tougher position even than they were in 2022 when it was pretty clearly a demand pull inflation scenario. And so what we've seen is the consumer price index, which is a common measure of consumer price inflation. It's now up to 3.3% year over year as of the March report. Which is a pretty big move from the 2.4% it hit earlier this year when it was looking like inflation was pretty well tamed. So now, I think the Fed has to rethink one, they probably can't lower interest rates with inflation, well above their 2% target now at 3.3%. Does it mean they'll raise interest rates? On the inflation number alone, not necessarily, just because, again, raising interest rates isn't going to have as positive an impact on cost push inflation like it did in 2022 on demand pull, where the Fed was able to raise rates, slow down the pace of demand and help inflation start to trend back down to more normal levels.
Yeah. How is the job market playing a role in this?
Well, that's the other interesting piece that, yeah, very recently we've seen strong jobs data. The U.S. economy added an estimated 115,000 jobs in April, which well exceeded the expectations of just 65,000 jobs, and really, conforms kind of a recent trend of good job growth, low unemployment, low, claims, people filing new claims for unemployment insurance, all of those things that we look at. So, a strong jobs report, would normally be indicative of kind of, you have strong jobs and strong labor market and higher inflation. That's indicative of an economy that's running maybe a little too hot,
Mm.
right? And so the Fed would want to slow growth, which means potentially raising rates. So that dual mandate that the Fed has of price stability, keeping inflation in check, and full employment, keeping a strong labor market. If anything, right now, because the labor market is strong, it really points that they would focus more on the inflation side, and with inflation bumping up, clearly much more difficult to make a case that the Fed will be lowering interest rates anytime soon. And to some extent, some areas of the market, they're even pricing in the possibility the Fed may raise rates
Mm.
towards the end of the year.
Yeah, so but essentially these two factors are kind of pulling in opposite directions, so it almost makes sense why they're leaving rates as is for now.
Exactly. Yeah, the Fed's job is to find the balance between those two factors, right? They really can't affect one without affecting the other. So they have to look at it and kind of say, which one is out of line, right? Which one are we more concerned about? And so at this point, that would probably be inflation being too high. And then they look over on the job side and they say, okay, the job market looks strong. We don't really need to be worried about that, right? So we could act to impact inflation, but you're right. It's not so far out of line, and because it's cost push inflation, they really have limited ability to have a
Right.
major impact on it, right? So, do you want to, hurt the job market and hurt job growth in order to try and bring down inflation, where you may have limited impact by raising interest rates? Which is why I think the market is pretty balanced right now. If you look at it, the market's pricing in a 57% probability. That the Fed will keep rates basically flat where they are for the year. And then interestingly enough, there's about a 20% probability that the Fed will cut interest rates by 1/4%. So, those were kind of swapped. The opposite, it was about a 60% probability that they would cut this year, and a 20% probability they'd hold tight, maybe a 20% probability that they would raise. So it's shifted now where it's much more likely that they'll hold interest rates steady, with about a 20% probability that they'll cut interest rates, and like an 18% probability that they may raise interest rates, which, that probability has definitely been moving up from a very, very low probability earlier this year to, still low, but starting to enter into the conversation.
Yeah. Well, depending upon what the feds decide to do, how does this impact borrowers, either, us private citizens, businesses, and what about governments? We have talked about what governments do with currency and not just their own.
Yeah, this is where the future path for the economy, for investors, especially in fixed income markets like the bond market, I think also have to rethink their views. I mean, part of it is even if the Fed were to lower interest rates, it probably wouldn't have a major impact on the longer term interest rates that impact most borrowers,
Mhm.
right? The Fed funds rate is the shortest of the short term interest rates. We typically don't borrow for, overnight, right? We're borrowing for 3 years, 5 years, 30 years on a mortgage. Borrowing for one night is really not that useful for consumers. And longer term rates are determined by supply and demand in the market, right? How much demand there is for money to be borrowed at certain maturities, and how much supply there is from investors that are willing to lend, at that risk level over those time periods. And I think the real challenge is with the government, having such high demand for money because of high deficit spending that puts upward pressure on interest rates. I think that's the reason why we're seeing things like mortgage rates above 6%, even when inflation was down in, the 2 to 3% range. That high demand for money was keeping rates higher. And without an offsetting corresponding increase in supply of money, interest rates are going to stay high. Now, I think earlier this year, you could have made the case that maybe the next recession would be a deflationary recession, right? That's when, the spending slows. Everybody wants to hold on to money because they want to make sure they've got money squirreled away to pay their bills, to be able to pay their debts. Maybe they're worried about, future cash flows or the stability of their job, right? And that becomes very deflationary. And typically what happens in those scenarios is you see a flight to safety. People sell risky assets, go to lower risk assets. You have this increased supply of money willing to be lent at low interest rates on, for relatively low risk. And it brings rates down, which of course then, stimulates the economy. You could see a scenario where maybe it finally gets the real estate market going, right? People that have bought houses in the last several years would be able to refinance into lower interest rates, maybe have more cash flow. All of that would help the economy. But now you could argue there's an increased risk of stagflation, which is, where the rate of economic growth slows, but inflation remains elevated due to that cost push inflation. Well, in that scenario, you might still have the rough economy, kind of like we did in 2022, but you don't see interest rates come down. In fact, if anything, they might even go up if that inflationary pressure exists, which suddenly, really changes your focus in terms of, how you want to protect yourself from a personal finance standpoint, but also, what makes sense as an investment strategy.
Yeah, so it's an interesting time to certainly continue to watch around interest rates, what Fed policy will do here moving forward, and really keep an eye on what the actual factor is and not just the headline.
Right, absolutely. Yeah, you want to see confirming data across multiple markets and across multiple sources.
Yeah, yeah. Oftentimes people just get one part of it and don't see the overall big picture. So, all right. Well, let's jump into diversifying digital assets. We talk a lot about diversification and investing, why it's important, how it builds, my words, a safety net in. But even in the digital space, so cryptocurrency like Bitcoin and so on, we're seeing a greater growth of diversification there as well.
Yeah, so Matt wrote this article, which I thought was pretty interesting. Being one of the younger guys, right, fairly new to the business. I think digital assets are not maybe not as exotic or new, right, for someone in his situation as it might be for somebody like me that's been doing this a long time, and has seen a lot of things come and go, and maybe is a bit more skeptical on their staying power. But he made a good point, about the diversification, right? That you do see a lot of people that are either, real believers in digital assets and really load up on them, right? Which obviously taking a lot of risk, really banking on that digital assets are going to continue to grow and be here to stay. Then you have others, right, that are, likely to stay away from those markets and stick to more traditional investing. And, we see a lot of that with stocks and bonds. And, we've even introduced alternative investments as a additional way to diversify, which,
Hmm.
I think has been pretty successful. But more traditionalists even shy away from that, right? And clearly they're going to be very leery of digital assets. But you know, if you're a real believer in digital assets, it still makes sense to diversify into other type of financial assets. You're likely taking far more risk than you think. But also, to look at even within that space, right? There's times when a digital currency like Bitcoin may be doing better, but other times when the companies that support
Yeah.
this whole kind of crypto ecosystem will do better, right? And even if you're a real believer in that space and its future potential, diversifying across not just owning those digital assets, but also owning the companies that are directly or indirectly involved can be a way to achieve greater diversification and thus better risk adjusted rates of return.
Yeah, because we did see that historically, where there were a few companies that there ended up having to be, some restitution, so to speak, made to investors through that use their digital wallet, so to speak. So definitely has held its risk, and as someone that held digital currency at one time, I did see a drastic volatility that I did not see in my, we'll say, traditional investments.
Right. Yeah. And that's exactly it, right? That's the reason for diversification is to reduce that. Yeah, I think you bring up some good points about some of the risks of, digital assets and crypto in general. Of course, there has been a real push among lawmakers to, better clarify, come up with, more kind of common sense rules and really defining that, the playing field, right, for different companies, which I think has been a real positive, and that, you have some guardrails, that, are not so restrictive to really try to hold back the growth of the industry, but are also not so broad or undefined that people don't know where that line is between, what will be considered acceptable and not acceptable by the regulators.
Yeah, well, speaking of that, what about government policy? I know Kevin Warsh, who might become the next leader of the Federal Reserve, he's spoken positively about digital assets.
Yeah, I mean, I think at least what you're seeing with a lot of the financial regulators is, they're willing to be pragmatic about it, right? I don't know that it's something that they are necessarily really promoting, but I think it's something that they're willing to work within, existing regulatory frameworks and willing to expand some of those frameworks to include some of these digital asset activities, whether it's the Genius Act or the Clarity Act or, that at least lays out, what the rules are, what can and can't be done, and provides protections for, the companies operating in those areas and the investors that support them, in addition to providing, some legal framework and regulatory protections for consumers that may be investing in those types of assets.
Yeah, because early on it was the wild, wild west, and some people came out good, and a lot of people not so much. So let's jump back to the importance of the diversification if you are investing in digital assets. What is kind of a standard of really most portfolios if you look at it as far as diversification, in addition to obviously holding some digital assets?
Yeah, I mean, obviously it depends on, individual situation, their goals, their time horizon, right? As to, what's the rate of return targets, what level of volatility they're able to withstand through the highs and lows of different market cycles, and the level of diversification that makes sense to achieve that, right? But I think, alternative investments, often can help during periods of high market volatility because they're non-correlated to the more traditional assets. And, there's at least a chance that they may be going up while other parts of the portfolio are going down. And, whether that's real estate, commodities, right? Obviously, which we were just discussing. But even digital assets may have a place in there because they don't always move the same way as stocks or bonds. Of course, there's many different ways to achieve a similar target, using a different mix of assets that may be acceptable or unacceptable to a given client.
Yes, sir. All right. Well, let's jump to IRS Direct Deposit. Executive Order 14247 mandates that all federal government agencies transition to electronic payments for all forms of federal disbursements. So this is important to know. If you're looking for that paper check, so to speak, be notified.
Yeah, this was something the IRS kind of, put out there, but I don't think was real clear in their communication until, we were getting most of the way through tax season. I mean, at first they said, we're just trying to encourage people to, do more electronic forms of payment, right, or of getting refunds. The idea is that yeah, they're trying to use that to reduce fraud. Obviously it's more efficient. It takes less time to do these electronic payments. Um, but some people aren't comfortable with that, right? They just want a paper check, and the understanding was that yeah, it'll be delayed, but you'll get paper checks. What's been interesting is the IRS has been sending out a lot of notices, the CP 53E, requesting bank information for people that basically, didn't provide it or requested a paper check. And at least the understanding is, they likely will eventually issue a paper check if they don't get that bank information. But it seems like they are purposely really delaying those paper checks to try to push people to, switch to electronic payment. Either by doing that on the original return or by logging into their IRS portal and putting in their bank account information. So I think what we're seeing is, basically, it's not necessarily an outright requirement, but just through, the lack of convenience and the delay, they're really pushing taxpayers to do everything with digital payments going forward. So it's probably going to be an area where we're going to need to adapt.
Yeah. Well, and it's important, I think, to note here, and I'm glad this was included, that you can go to the IRS website and check online that where's my refund. And to my understanding, you go there, it'll let you know, but then it also, once again, prompts you to do the digital sign up and provide your routing number and account number there to essentially, it's a nice way of saying you do this, you get it quicker.
Yeah, exactly. Yeah. Or, we're going to take our sweet time because, you're electing a form of payment that we're really resisting.
Yes, sir. Are there any exemptions around direct deposit?
There are some available, where you can make the election, or again, like you can just, not do it, and eventually they will send a check because obviously it is required that they refund the money. And some people can do it based on, I mean, just lack of well, in some cases the unbanked, right? I mean, lack of even having a bank account. Unfortunately there's a lot of people that do have to rely on check cashing services and things like that because maybe they had a history of overdrawing their bank account, their checking account or that type of thing. So that would be an example. I think some people, in terms of just not being internet savvy, age, things like that. But in most cases, it's best to even if you're struggling to comply, ask for help.
Yes, sir. As well as important that you noted here as well, recommend updating and adding your banking information to your state tax agency as well. So not just federal, because the states have moved this direction too.
Yeah, I mean that's typically the way it often goes, right? They anything that will save money, they will conform to the federal policy.
Yes, sir. All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. Two items pinned up there this week. What do we got?
All right. Well, we're through tax season, so now we're working on filing Form 5500. So these are informational returns that are filed with the Department of Labor for 401k type plans or employer-sponsored retirement plans that meet certain criteria. So we've been going through and filing them for clients that have solo 401k plans, right? These are typically, self-employed, one person company, where they can set up a plan and they don't need to go through all of the rigmarole of getting a TPA, a third party administrator, and all these other things if they were running a company and had employees. So we do those simple ones, whereas typically if someone's a business leader and they're responsible for the company retirement plan, they would be responsible for that 5,500. So it's just a reminder, if anyone has a solo 401k or some type of plan out there that we're not aware of, if it's over 250,000 in value, then you now have a requirement to file the Form 5500. If you work for a business where you have that responsibility, it's important to make sure your TPA, your third party administrator, is filing that form on time. It's an informational return. There's no tax due with it, so it's easy to kind of not take real seriously. But if you don't file, the penalty can be as high as $250 a day. Mm-hmm. So that's which is the big penalty.
Yes, sir. What's the second item we have pinned up there on the bulletin board?
Yeah, so another one of those filings that, again, is an informational filing. This is the Report of Foreign Bank and Financial Accounts, or often called the FBAR filing. So these are informational reports that are required by U.S. citizens, green card holders, and or residents who have an ownership interest in a foreign bank account if the value of that bank account exceeded $10,000, right? Obviously, you probably have to do the exchange, which is always difficult to say, okay, at any time during the year, did it exceed $10,000? Either because, there was a deposit, some interest, or because the exchange rate changes that day, right? And suddenly that currency became worth more in dollar terms. But if someone does, then, it's really important to go online and file that FBAR, just, basically letting the government know about the account, because there's no cost to it. There's no tax due, but failing to file can result in penalties of $10,000 or more. In some cases, it could even be half the value of the account. So I know we have a number of clients that are on our radar that we follow up with every year to make sure that that's done. But of course, if someone has a foreign bank account that we are not aware of, that's something that we definitely need to make sure is being addressed.
Yes, sir. Yes, sir. Anything you want to add while we wrap up this edition of the Plan Solutions Incorporated podcast?
No, just appreciate the effort you're putting into keep this podcast going. It blew me away when I was looking at just how many newsletters we've done, and how many years it's been, and we've been doing this podcast a long time. Lee, the first personal financial review was in 2010. And, here we are in the middle of 2016. So 16 years of, I would say week in, week out, but I guess it's every other weekend, every week out of putting out this content. So I appreciate your efforts.
Oh, yes, sir. It's been an honor and a privilege. And hey, I get the firsthand education with an expert every time we talk. So I always appreciate it as well. Well, we appreciate you all for listening or watching on YouTube. Yes, you can go to our YouTube channel. It's youtube.com/@plansolutions and subscribe there. You'll get a visual form of the personal financial review, the written content we discuss here while you hear Chase and I discuss those topics. So kind of a way to cross-reference the information as we go along, or of course, Apple Podcasts, Spotify, wherever you get your podcasts. Hit that subscribe button as well, and please continue to share with others that you think will get value out of the podcast. We don't do any external advertising, so our continual growth is because of you, and we thank you. And of course, if you have yet to subscribe to the Personal Financial Review, the written content that we do discuss, it's simple to do so. Just send Katie an email, katie@plansolutions.com, and let her know you want to subscribe today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.